Hello and welcome to Quarterly Perspectives, First Quarter 2020. My name is Justin Rice and I serve as a financial advisor here at Personal Wealth Strategies, and I'll be your host for this presentation. The presentation is divided into two parts. The first part reviews recent asset returns, and the second part looks at recent market and economic headlines. We start our return discussion with a high-level look at a collection of major asset classes. As we can see from the illustration, U.S., international, and emerging market stocks all fell during the first quarter. U.S. and global bonds had positive performance during the quarter. Let's look a little deeper at what was driving the returns of stocks and bonds. We start by looking at how developed stock markets performed over the past 12 months. We can see a wide range of results, which speaks to the need to diversify. While it would have been great to have all our money invested in Denmark, the best performing country, investing in only one country introduces the possibility that all of our money could have been invested in Austria, the worst performing country. The dots on or near each country's bar represents how the local stock market performed over the past 12 months. A similar trend with an even wider range of returns occurred in the stock markets of emerging countries. Taiwan had the best return during the first quarter, and Colombia had the largest decline. Our evidence-based investment process has us favor several factors of return. One of those factors is a preference for small capitalization companies versus large capitalization companies. History has shown that small companies tend to outperform large companies over the long term. Looking back over the past 5 years, we see that outperformance in international developed companies, but we didn't see it in U.S. and emerging market companies. Another factor of return we emphasize is on value companies. Historically, value companies have outperformed growth companies over the long term. On these charts, when we see the lines going up, value outperforms growth. When they head down, growth outperforms value. Over the past 5 years, and illustrated on the graph on the left, we can see that large growth companies outperformed large value companies in every category. On the right-hand side, we look at small value companies and see that only emerging market small value companies have done well versus small growth companies. We also see that U.S. small value and international small value companies had periods when value outperformed and periods where they didn't. While we expect our factors of return to always deliver positive results, realized returns are often different. This is why we diversify into multiple factors of return. Turning our attention to bonds, we start by looking at recent interest rates. Here we plot what is referred to as a yield curve to show us how much interest we receive from bond investments with different maturities. The dark blue line represents interest rates at the end of 2019, and the light blue line represents interest rates at the end of the first quarter of 2020. Since the light blue line is lower than the dark blue line, we can see that interest rates decrease during the year. Bond prices rise when interest rates fall, and this helped boost bond results for the year-to-date period. We typically prefer investing in bonds that have shorter maturities and higher quality than the broad bond market. In the chart on the left side, we see falling interest rates aided longer maturity bonds during the first quarter. In the chart on the right, higher credit qualities performed better than lower credit qualities during the quarter. On this slide, we look at the absolute impact of different asset classes on a sample 65% stock, 35% bond index mix. With stock markets declining and bond markets advancing slightly in the quarter, we can see that almost all asset classes detracted from the overall gain. Fixed income and cash were the only positive performers this quarter. Looking at year-to-date asset class returns, we see asset classes in your portfolio ranging from a positive 2.3% for global short-term bonds on the high end to a negative 30.6% for U.S. small cap on the low end. Maintaining a diversified asset mix, such as a 65% stock, 35% bond mix, shown in white, kept us away from the more extreme returns from year to year, with significantly less volatility over the last 15 years, highlighting the importance of maintaining a well-diversified mix of asset classes in our portfolios. Let's now turn our attention to some of the major stories we saw in the most recent quarter. New information comes out daily, potentially impacting the direction of individual companies and the overall market. While this collection of headlines isn't meant to explain why the global stock market returned what it returned, we present it to help illustrate there's a lot of short-term news that may tempt us to make an investment decision we may regret. It is wise to stay informed, but we feel it is very important to keep a long-term perspective when it comes to investing. The one headline that most of us will notice right away: Coronavirus declared pandemic by World Health Organization. The global spread of the COVID-19 pandemic so far this year has dominated headlines and has shaped the lens through which we view investments, geopolitical affairs, and now life in general. But what's important to keep in mind is that we now find ourselves in a world that has significant global health and economic concerns, both of which have fueled extreme market volatility in the first quarter of 2020. A lot has changed in only a few short months. The market was approaching an all-time high at the end of 2019, only to be followed by one of the most precipitous drops in history midway through the first quarter of 2020. Mix in an oil trade war between Russia and Saudi Arabia, a near-complete seizure of U.S. and world economies, and the spread of a global pandemic. The cumulative effect has manifested itself in heightened market volatility that we will go on to explore throughout the next few slides. Here we see the VIX, an index created by the Chicago Board Options Exchange to track forward-looking, expected market volatility, otherwise known as the fear gauge or fear index. Notice that the two highest closing values since 2004 came in November of 2008, 80.86, only to be beat on March 16th with a closing value of 82.69. This chart shows us that some level of expected volatility and uncertainty has always existed, but we may not truly feel its impact until it shoots up from historic lows to before unseen highs. We see this volatility play out in the markets every day. Let's examine this from the perspective of daily returns of the S&P 500, for example. There was no shortage of media pundits urging investors to sell securities and sit on the sidelines until the markets calmed down. But as we can see here, nearly every bad day was followed with a relatively similar up day. Out of the 62 trading days in the first quarter, it was an even split between up days and down days. This market phenomenon is referred to as volatility clustering, which is the idea of significant single-day market drops being followed in the subsequent month by additional waves of volatility or clusters. For further insight on volatility clustering, please reference the article, "Are the Market Aftershocks We Just Saw Normal?" by Larry Swedroe at advisorperspectives.com. The underlying cause of this current volatility we are experiencing is due in large part to the uncertainty surrounding how we will be able to function as an economy while simultaneously combating the spread of COVID-19. The U.S. government has played an active role in stemming the economic fallout through a series of actions providing much-needed liquidity to securities markets, businesses, individual consumers, as well as encouraging the practice of social distancing. And the good news is that it appears to be working to some degree. It's times like these that validate our fixed income strategy. We feel that remaining low in duration and high in credit quality provides the proper ballast to a portfolio during periods of market volatility. We can see that the only two bond asset classes that experienced negative performance in the last quarter and or the last 12 months are those whose duration is too long and those who are below investment grade. To put the role of fixed income in a clearer perspective, take a look at this broad asset class performance. All individual equity asset classes were down in the first quarter and the trailing 12-month period. But a moderate portfolio mix of these asset classes, 65% equities to 35% bonds, was supported in large part by its fixed income components. After conducting some internal research on our own, we remain cautiously optimistic that the foundation of our long-term investment strategies, small cap value stocks, are in a favorable position. We observed the 24 largest drawdowns in market history and compared the relative performance of small value to the total market. We found that small value underperformed by an average of 3.6%, or 6.1% if we exclude the bursting tech bubble of 2002 during market drawdowns. However, we found that during the subsequent recoveries, small value outperformed the total market by 20.5%. Nothing in life is guaranteed, but we are hopeful regarding the future. This concludes our presentation for today. Thank you again for joining me. Until next quarter, stay safe. To review this or past commentary, please see Personal Wealth Strategies YouTube channel or visit us at our website, www.personalwealthstrategies.com.